Imagine paying for your family holiday months before boarding the aircraft, believing everything has already been arranged. The flights, the hotel, the airport transfers, the tour guides. Everything appeared secure. Then, just days before departure, the company organizing your entire holiday disappeared. Not because people stopped traveling, but because it could no longer finance the holidays it had already sold. On 23 September 2019, Thomas Cook, the world's oldest travel company, collapsed into compulsory liquidation. More than 600,000 holidaymakers were overseas. Around 150,000 British travelers suddenly needed to be brought home. It became the largest peacetime repatriation operation in British history. Hotels demanded payment before allowing guests to leave. Flights were canceled. Employees arrived at work only to discover the company no longer existed. The collapse shocked the world. Because Thomas Cook wasn't a young startup. It wasn't an online travel agency chasing rapid growth. It had been part of the travel industry for nearly 180 years. Founded by Thomas Cook, the company pioneered organized tourism. It introduced package holidays, traveler's checks, escorted international tours, and helped make overseas travel affordable for ordinary families. Over generations, millions of people booked their first holiday through Thomas Cook. The yellow heart logo became one of the most recognizable travel brands in Europe. By the 2010s, Thomas Cook operated airlines, owned hundreds of travel agencies, managed hotel brands, sold package holidays, and served millions of customers across Europe every year. It appeared to control almost every stage of a holiday: booking, flights, hotels, transfers, customer support. But hidden beneath that enormous travel empire was a business model that depended upon something far more fragile than airplanes or hotels: cash. Not annual profit, not market value, daily cash flow. Because long before customers arrived at their destinations, Thomas Cook had already promised money to airlines, hotels, airports, and thousands of suppliers around the world. For decades, that financial machine worked almost perfectly, until one day it no longer had enough cash to keep the next holiday moving. For almost 2 centuries, Thomas Cook sold holidays. But what it was really managing was cash. To understand why the company eventually collapsed, you first need to understand how a package holiday actually works. Imagine booking a family holiday to Spain 6 months before departure. You pay Thomas Cook today, but your holiday doesn't begin for another 6 months. At first glance, it appears the company has already earned your money. It hasn't. That payment creates a promise. Thomas Cook must now deliver an entire holiday months into the future. Flights, hotels, airport transfers, resort staff, customer support. Every part of the journey must still be paid for. Some suppliers required deposits months in advance. Hotels often reserved thousands of rooms before the holiday season even began. Airlines committed aircraft, crew, fuel, maintenance, and airport slots long before passengers boarded. Thomas Cook constantly negotiated contracts with hotels and airlines around the world, agreeing to purchase enormous volumes of holidays before knowing exactly how many customers would ultimately book them. That strategy created attractive prices for travelers, but it also created enormous financial commitments. Imagine agreeing to reserve 500 hotel rooms every night throughout the summer. Even if only 400 customers arrive, the remaining rooms may still need to be paid for. The same principle applied to aircraft seats. If flights departed with empty seats, many operating costs still remained. Success therefore depended on one thing: selling enough holidays at the right price to cover commitments that had often been made months earlier. During strong economic conditions, the model worked remarkably well. Millions of customers booked holidays early. Cash flowed into the business continuously. That incoming cash helped finance future operations, while new bookings replaced customers already traveling. It became a constantly moving financial cycle. Today's bookings helped support tomorrow's holidays. Tomorrow's bookings helped finance holidays after that. As long as bookings remained strong, the machine kept moving. But hidden beneath that success was one dangerous dependency. The system constantly needed fresh customer bookings and continuous cash flowing into the business. The moment that flow began slowing, the pressure would spread through every part of the company. For decades, the package holiday machine worked because customer bookings remained remarkably predictable. Families planned summer holidays months in advance. Hotels were filled. Aircraft departed close to capacity. Thomas Cook could confidently negotiate enormous contracts years ahead. But during the 2000s, the travel industry began changing. The Internet transformed how people booked holidays. Instead of purchasing complete package holidays from one travel company, customers increasingly booked flights, hotels, and activities separately. Low-cost airlines like Ryanair and EasyJet made independent travel dramatically cheaper. Online platforms such as Booking.com gave travelers direct access to thousands of hotels worldwide. Consumers suddenly had more flexibility, more choice, and greater price transparency than ever before. Thomas Cook's traditional advantage, bringing every part of the holiday together, was becoming less unique. Management understood the threat. Rather than shrinking the business, they attempted to protect market share. The company continued operating hundreds of retail travel stores, maintaining its own airline, supporting hotel brands, and honoring enormous long-term hotel and aircraft commitments built for a much larger package holiday market. Those fixed costs remained, even as customer behavior changed. Imagine owning a shopping center designed for 10,000 visitors every day. If only 7,000 customers arrive, the building still requires security, electricity, maintenance, cleaning, and staff. Thomas Cook faced the same problem across its global operations. Large parts of the business cost almost the same to operate, whether holidays sold quickly or not. Competition intensified further. Online travel agencies carried far fewer physical assets. They didn't own airlines. They didn't operate hundreds of high-street travel shops. Many simply connected customers with existing airlines and hotels through digital platforms. Their business models were lighter, more flexible, and required far less capital. Thomas Cook wasn't just competing against other travel companies anymore. It was competing against an entirely different way of selling holidays. The company still generated billions in revenue. Millions of customers still traveled every year. But underneath those impressive sales, its financial flexibility was quietly disappearing. The travel empire had become much larger than the changing market could comfortably support. Changing customer behavior was only part of the problem. Thomas Cook's balance sheet was already carrying another growing burden: debt. Years of acquisitions, expansion, and restructuring had left the company with billions of pounds in borrowings. Debt itself isn't necessarily dangerous. Many successful businesses use borrowed money to grow. The real question is whether the business generates enough cash to comfortably repay it. Thomas Cook increasingly struggled to do that. Imagine buying several investment properties using loans. As long as rental income comfortably covers the mortgage payments, the strategy works. But if rental income gradually falls while loan repayments remain unchanged, more and more cash is consumed simply servicing debt. The properties still exist, but they no longer strengthen your finances, they weaken them. Thomas Cook entered a remarkably similar cycle. Every year, the business first needed to pay interest on its borrowings before that cash could be invested into modernizing technology, improving customer experience, reducing prices, or strengthening the balance sheet. Debt quietly became one of the company's largest fixed costs. Then came another problem. Brexit uncertainty reduced consumer confidence across the United Kingdom. Many families delayed expensive overseas holidays. At the same time, the British pound weakened against the euro and the US dollar. That made many overseas hotels, fuel purchases, and foreign operating costs more expensive for British travel companies. Then, Europe experienced one of its hottest summers in decades. Instead of traveling abroad, many families chose to holiday within the United Kingdom. Bookings softened again. Individually, none of these events would likely have destroyed Thomas Cook, but together they steadily reduced the fresh cash flowing into the business. Meanwhile, interest payments, hotel commitments, aircraft costs, store operations, and supplier obligations continued. The company's financial machine had become trapped. More cash was leaving the business each day than new bookings were replacing. The problem was no longer competition, it was liquidity. Thomas Cook still owned valuable brands. It still carried millions of passengers. It still generated billions of pounds in annual revenue. But revenue alone couldn't save the company. Only cash could. And that cash was disappearing faster than management could replace it. By September 2019, Thomas Cook was no longer trying to improve profitability. It was trying to survive the next few days. The company urgently needed new financing, not to expand, not to acquire competitors, simply to continue operating. Earlier that year, its largest shareholder, Fosun Tourism Group, proposed a major rescue plan. The agreement would inject approximately $900 million into Thomas Cook. The proposal involved splitting the company. Fosun would take control of the tour operator and travel business, while Thomas Cook's lenders would become the principal owners of the airline. For months, management worked to finalize the rescue. It appeared the company might survive. But as negotiations continued, another problem emerged. Banks and creditors became increasingly concerned that even after the rescue, Thomas Cook might still require additional cash during the quieter winter travel season. They demanded a further $200 million of contingency funding before completing the deal. That final requirement became the turning point. Management spent frantic days searching for additional investors, government support, and emergency financing. Meetings continued almost around the clock. Potential solutions were explored, but time was running out. Hotels still expected payment. Aircraft still required fuel. Employees still expected wages. Customers continued booking holidays, completely unaware that the company itself was running out of cash. Unlike many corporate collapses, Thomas Cook wasn't overwhelmed by billions of pounds in immediate losses. It was defeated by one simple reality. It didn't have enough available cash to continue funding tomorrow's holidays. Without the additional $200 million, the rescue agreement collapsed. Years of restructuring, billions in revenue, millions of loyal customers, and nearly 180 years of history had all come down to one final liquidity gap. The company wasn't out of business yet, but it had reached the point where every remaining hour depended on money that never arrived.
On the night of 22 September 2019, Thomas Cook's final rescue negotiations came to an end. The additional funding could not be secured. Without it, the company had no realistic way to continue trading. In the early hours of 23 September, Thomas Cook entered compulsory liquidation. Almost immediately, its enormous global travel machine stopped. Aircraft remained on the ground. Future flights were canceled. Travel agencies closed their doors. Hotel contracts became uncertain. Thousands of employees suddenly found themselves without jobs. But the greatest challenge wasn't inside the company. It was overseas. At that moment, more than 600,000 Thomas Cook customers were already on holiday around the world. Approximately 150,000 of them were British citizens. Many had return flights booked on Thomas Cook aircraft that would never arrive. Hotels across Greece, Spain, Turkey, Cyprus, and dozens of other destinations suddenly questioned whether they would ever receive payment. Some hotels continued looking after guests. Others requested immediate payment before allowing travelers to check out. Families who believed every part of their holiday had already been paid for suddenly faced enormous uncertainty. The British government activated Operation Matterhorn. It became the largest peacetime repatriation operation in British history. Chartered aircraft from airlines across the world replaced canceled Thomas Cook flights. Special flight schedules were created almost overnight. Airports coordinated emergency departures. Passengers were flown home at no additional cost. For days, aircraft carrying temporary flight numbers crossed Europe, collecting stranded travelers one airport at a time. The operation eventually returned more than 140,000 British holidaymakers safely home. Thomas Cook had spent almost 180 years taking people on holiday. Its final journey was organized by the government. The company that once connected millions of families to the world had become one of the largest emergency rescue operations the travel industry had ever witnessed. Thomas Cook's collapse ended one of the most recognizable names in global tourism. But it did not end the package holiday industry. Flights continued. Hotels remained open. Millions of people still traveled every year. What changed was how the industry managed risk. Travel companies became far more cautious about debt, working capital, and long-term commitments. Many shifted toward lighter business models. Instead of owning airlines, large hotel inventories, and extensive retail networks, they increasingly partnered with specialist providers. Digital platforms accelerated that transition even further. They connected customers with airlines and hotels without carrying the enormous fixed costs that had weighed on traditional tour operators. The travel industry also learned another lesson. Revenue does not equal liquidity. Thomas Cook generated more than $9 billion in annual sales before its collapse. Yet, despite those enormous revenues, it could not secure the cash required to survive its final days. Its downfall became a case study in business schools, boardrooms, and corporate finance courses around the world. Not because people stopped traveling. People still wanted holidays. Aircraft still flew. Hotels still welcomed guests. The demand never disappeared. The cash did. Thomas Cook spent almost 180 years making travel easier for ordinary families. It pioneered package holidays, opened the world to millions, and transformed international tourism forever. But in the end, its greatest challenge wasn't convincing people to book holidays. It was financing the promises those bookings created. Thomas Cook wasn't ultimately defeated by online competition, it wasn't defeated by Brexit, and it wasn't defeated by one failed rescue.
It was defeated by a business model that gradually accumulated more financial commitments than its daily cash flow could continue supporting. For nearly 2 centuries, Thomas Cook promised to take people around the world. Its final lesson was that even the world's most trusted travel brand cannot survive when tomorrow's promises become larger than today's cash.